Assalamualaikum warahmatullahi wabarakatuh. My name is Fazana Barkis binti Fauzi, and today I would like to start our presentation by giving some background information on one of the companies. WCT Holdings Berhad was first established on 14 January 1981 and was first known as WCT Group. Now, it was incorporated with WCT Earthworks and Building Constructors Sdn Berhad. It operates through two subsidiaries known as WCT Berhad and WCT Land Sdn Berhad. WCT Berhad involved in engineering and construction industries and has taken projects such as F1 racing circuits and MRT2.
Sunway Construction Group Berhad, or Suncon, is a leading Malaysian construction company and a key subsidiary of the Sunway Group. Established in the 1980s, Suncon has grown from its early days in building construction to a diversified leader in infrastructure, civil engineering, and MEP service. Publicly listed on Bursa Malaysia in 2015, Suncon is known for high-profile projects like the Klang Valley Mass Rapid Transit and the numerous high-risk development. Committed to sustainable practice, Suncon is expanding its presence in Southeast Asia and India. With a strong order book and diverse portfolio, Suncon well positioned for continued growth and innovation.
Liquidity ratio refers to the ability of the company to pay its current obligation using current assets. Now, under liquidity ratio, we have net working capital (NWC), which is used to measure the company's excess fund available after paying its current liabilities. The higher NWC, the more liquid the company is. For the trend analysis, WCT Holdings' net working capital were decreasing from 2019 till 2021, but later on rises on 2022 and 2023. The trend goes the same with Sunway Construction Group Berhad. Based on the graph shown here, WCT Holdings' net working capital is better than Sunway's in the past 5 years. This shows that WCT Holdings has more excess fund available rather than Sunway's company. Next is current ratio, CR. CR is used to measure the company's ability to pay its current liabilities using its liquid fund. Now, the higher CR is, the more liquid the company is. WCT Holdings shows a stable current ratio in the past 5 years, where it has slightly decreased in 2020 and 2021, but then has a slight rises in 2022, but then decreased a little bit in 2023. Now, Sunway's company also shows the same trend in the past 5 years, where it decreases from 2019 to 2021, but then rises in 2022, then slowly decrease in 2023. Based on the graph given, both of the companies shows a good current ratio. However, in 2019, 2022 and 2023, Sunway's current ratio are much better than WCT Holdings Berhad, while in 2020 and 2021, WCT Holdings Berhad current ratio are much better than Sunway's.
Assalamualaikum. My name is Nordiana binti Muhammad Nur Farisad and I will presenting profitability ratio. The first one is gross profit margin, GPM. WCT Holding has experienced a significant decrease from 24.23% in 2019 to 2.64% in 2023. Sunway Construction has shown a fluctuation from decrease in 2020 with 17.4% but then improved to 20.68% in 2021 before decreasing to 16.25% in 2023. Based on data, we can see that Sunway Construction has demonstrated more stable profitability than WCT Holdings, which has experienced a sudden decline. Secondly, OPM, operating profit margin. WCT Holding has experienced an inconsistent trend from 10.54% in 2019 to negative 0.53% in 2023. Sunway Construction has shown a slight fluctuation from 7.97% in 2019 to 8.4% in 2023. Based on data, we can see that Sunway Construction has a stronger ability to manage operating costs, while WCT Holding failed to manage their own operations. Basically, Sunway Construction Group Berhad has maintained more consistent and stable profitability in both GPM and OPM despite all the challenges. In contrast, WCT Holding Berhad has struggled to maintain their profitability due to issues such as cost management and operation efficiency.
Now I will presenting the account receivable turnover (ARTO) analysis for WCT Holding and Sunway Construction Berhad from 2019 to 2023. Firstly, what is ARTO? It measures how efficiently a company collects revenue from its credit sale. Looking at WCT Holding, they show slight improvement in 2020 with a ratio of 2.62 up from 2.49 in 2019. However, they faced challenges in 2000, dropping to 1.96. The ratio improved in 2022 to 2.78 but declined again in 2023 to 2.14. indicating inconsistency in their collection efficiency. Now for Sunway Construction, starting at 2.16 in 2019, they saw reduced efficient in 2020, which a ratio of 1.79. However, strong gains are made in 2021 and 2022, which ratio increasing to 2.88 and 3.18, reflecting improved collection practice. In 2023, the ratio dipped to 2.15, signaling a potential slowdown. In addition, Sunway Construction had a stronger collection efficiency in 2021 and 2022 compared to WCT Holding. Now I will discussing the total asset turnover TETO analysis for WCT Holding and Sunway Construction from 2019 to 2023. Firstly, what is TETO? TETO is total asset turnover, measure how efficiently a company uses its asset to generate sale. Looking at WCT Holding, their TETO ratio remained relatively stable, ranging from 0.2 to 0.25. There was a slight dip to 0.2 in 2020, indicating some challenge in asset utilization. An improvement was seen in 2022, reaching 0.25, but the ratio reverted to 0.2 in 2023, reflecting consistent but limited efficiency. Now for Sunway Construction, they consistent outperformed WCT Holding, which ratio between 0.81 and 0.96. A decline to 0.81 in 2020 was likely due to economic challenge. However, the company rebounded in 2021 and peaked at 0.96 in 2022, showing strong asset management. In 2023, the ratio slightly decreased to 0.87 but still remains significantly higher than WCT Holding. In addition, Sunway Construction has demonstrated more effective asset utilization, generate more revenue compared to WCT Holding.
Hi, Assalamualaikum Doctor. My name is Nur Enalda Sofia, but you can call me Nel. For my part, I'm going to give a brief explanation for leverage ratio. The debt ratio means how much of a company's assets are paid for with borrowed money. So, it could be high ratio and low ratio. So, a high ratio means the company uses more debt. However, a low ratio means the company uses less debt. That means most of the company's assets are paid using its own money. So, as you can see the diagram here, it shows WCT Holdings Berhad and Sunway Construction's Berhad performance from 2019 to 2023. So, from 2019 to 2020, WCT Holdings Berhad debt ratio dropped from 0.58% to 0.53%, but went up slightly to 0.7% in 2023. This shows that WCT Holdings used a bit less debt over the years but started using a bit more in 2023. This shows that the company has a stable debt use. For Sunway Construction Berhad, the debt ratio stayed at 0.67% in 2019 and 2020, then dropped to 0.62% in 2021, then went up to 0.63% in 2022, and then rose to 0.71% in 2023. This means Sunway Construction Berhad used less debt from 2019 to 2021, but increased debt use from 2022 to 2023. As we all know, 2020 is the year of pandemic, right? So of course, the company borrowed much money to finance its new projects, operation, and many more. So, Sunway has higher debt ratio than WCT Holdings, right? Meaning that Sunway relies more on debt to finance its assets compared to WCT Holdings Berhad. A higher debt ratio can suggest higher financial risk, but also the potential for higher returns if the borrowed money is used effectively. Okay, maintaining a lower or stable ratio can be a sign of good financial health, as it indicates that the company is not overly dependent on borrowed money. So now we are talking about the debt to equity ratio. It actually has the same meaning with debt ratio, which is the debt to equity ratio shows how much a company relies on debt compared to its own money. So if the company has high ratio, that means the company uses more debt. Otherwise, it uses less debt. So as you can see in this diagram, from 2019 to 2020, WCT Holdings relied less on debt, but their debt increased again in 2023. Sunway Corporation's Berhad has a similar pattern, okay, with less debt from 2019 to 2021, but more debt from 2022 to 2023. Sunway always had a higher debt to equity ratio rather than WCT Holdings Berhad, showing that the company relied more on debt, which could mean more financial risk or different business approach. So you can see here, right, that WCT Holdings uses less debt than Sunway, but both companies are using more debt in 2023. Why? This might mean they are changing how they handle their finances, which could impact their businesses. Some of the potential causes are new projects, economic conditions, and many more.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Alif Nazmi bin Fadzil, and I will be continuing the presentation by presenting the market ratio. We will be discussing about earning per share and dividend per share. Earning per share, or EPS, is a measurement that represents the portion of a company's profit allocated to each outstanding share of common stock. EPS measures the amount of profit available to the shareholders based on the company's earning. Based on the data collected, the EPS shows that WCT Holdings has a more stable and upward trending EPS. And based on the diagram above, it actually indicates that WCT Holdings has been consistently improving its profitability over the years. This might be due to effective management strategies, cost control, or favorable market condition. On the other hand, Sunway Construction Group Berhad shows a more volatile EPS trend. From the diagram, the uneven increase and decrease of EPS suggests that the company faces challenges in maintaining consistency of profitability. On the other hand, dividend per share, or DPS, represent the portion of a company's earning distributed to shareholders for each share they own in dividend. The dividend is given as the company's approach in returning the value to its investors. Sunway Construction Group Berhad has maintained a higher and relatively stable dividend per share compared to WCT Holdings Berhad. Based on the diagram above, it suggests that Sunway is more focused on returning to its shareholders through dividends, and investors might prefer Sunway Construction Group Berhad due to its higher and more stable dividend payments. In contrast, WCT Holdings Berhad shows a declining trend in DPS. From the diagram, we can see that the company is retaining more earnings for reinvestment purposes rather than distributing them to the shareholders. This strategy might be aimed for the company's long-term future. In conclusion, financial ratios is an important analysis tool to analyze a firm's financial performance over a certain period of time. Financial ratios help evaluate a company's financial health by showing its liquidity, profitability, efficiency, debt use, and their market performance. From the data that we can see, the analysis between WCT Holdings Berhad and Sunway Construction Group Berhad shows significant differences in the organization's financial performance and their strategy. WCT Holdings has a stronger liquidity, while Sunway Construction Group Berhad shows a more stable profits, efficient asset use, and higher dividends. Sunway's higher debt may drive a faster growth, while WCT is a more stable with less debt and focuses on reinvestment. Overall, Sunway may be better for investors who are seeking for steady profits and dividends, while WCT is more suitable for those prioritizing stability. These ratios help understand each company's financial priorities and strategic management potential.
Okay, to answer question 1, company management uses financial ratios to understand their financial health and make decisions. For example, during one-time events like pandemic in 2022, right? It's very chaotic, isn't it? So, they can look at liquidity ratios to see if they have enough cash to survive tough times. They might use profitability ratios to decide if they need to cut costs or find new ways to make money. These ratios give a clear picture of what is happening with their finances, helping them make smart choices quickly.
Secondly, financial ratio can be misleading due to inconsistent accounting practice. When companies use different accounting methods, it can distort financial ratio and make it unreliable. For example, if one company uses straight line depreciation while another uses accelerate method, the asset value and net income figure will differ, leading to misleading profitability ratio like ROA. Such inconsistency can obscure the true financial performance of a company and mislead stakeholders in their analysis and decision making.
How might a company's management use financial ratios in making strategic decisions? Now, for liquidity ratio, if there is not enough liquidity or current assets are lower than current liabilities, then the company's management can decide to enhance their cash flow to increase the liquidity of their company.
For profitability ratio, management can assess whether the company is generating sufficient profit relative to its sales, asset, and equity. For instance, if profitability ratio are declining, management might decide to streamline operation, reduce costs, or adjust pricing strategy to improve margins.
Financial ratios are essential tools that help management evaluate different aspects of a company performance, such as efficiency, profitability, and liquidity. Ratios like account receivable turnover and total asset turnover provide insight into how effectively a company is managing its receivable and asset. Firstly, identify operational strength and weakness. By analyzing this ratio, management can pinpoint areas of a strength and areas need improvement. For instance, a high total asset turnover ratio indicates effective asset use, while a lower ratio may highlight opportunity to enhance asset efficiency. Second, benchmarking performance. Comparing a company ratio with industry standards allow management to understand how well the company is performing relative to its peer. This comparison helps set realistic goals and identify successful strategy that can be adapted to improve performance. In conclusion, financial ratios are valuable tools that aid management in assessing performance that drive operational efficiency and business growth.
So management uses leverage ratios like debt to equity ratio and the debt ratio to make strategic decisions. The debt to equity ratio, as I mentioned before, shows how much debt that the company has compared to its own money. Okay, high debt to equity ratio might reduce borrowing to avoid too much risk. Okay, while the debt ratio shows the proportions of the company's assets that are financed by debt. A high debt ratio prompts management to pay down debt to improve financial stability.
Market ratio, such as EPS, shows how much profit the company makes for each share of stock. If EPS goes up, it means the company is doing well and management might decide to invest in new projects or expand the business. Conversely, if EPS goes down, they might look for ways to cut costs or improve how the company operates to boost their profits. On the other hand, DPS tell how much money the company give to the shareholders from its profit. Management will use DPS to decide how much should they reward the shareholders, and if they are trying to always keep the investors happy, they might increase the dividends to attract the shareholders. But if they need more money for growth, they might keep more profits instead of paying out higher dividends to the shareholders.